A very good morning, friends. So I hope you're all doing well. And as I always keep telling you, that I hope your cumulative revision on Indus 103 is going on. So just to remind you, we were looking at acquisition accounting and we're working on a 7-step model. And I am now on the step number 4, which is the calculation of the consideration trustword, or what we commonly call it as a purchase consideration. I give you the inputs in terms of the purchase consideration. There are a total of 7 agendas, or I would say the 7 special issues, which you need to keep in mind. When you calculate a purchase consideration, you consider the cash which is given by the acquirer to the shareholders of the acquiree and the fair value of the shares which are issued. But then there are 7 special issues to be taken. So we saw number 1, the concept of a DC, a deferred consideration, wherein you consider the fair value as a part of the PC, and that is nothing but it is a present value of the future payment. And that also leads to an unwinding of discount in the future. Then we saw the second aspect in terms of contingent consideration, which is to be checked. Is it in the employee capacity or the shareholders capacity? Because when you're making a payment to the shareholders of the acquiree, the shareholder of the acquiree could also be an employee of the acquiree. So if the payment is made, let's say for a future condition, which is a service condition, it is in the employee's capacity, not taken as a part of the PC. It would be accounted using other relevant Ind AS, generally 102, which is share-based payments. The third is that it is paid in the capacity of the shareholders when the conditions attached are not service, but the condition is any other factor other than a service condition. It is a part of the PC and it is taken at a fair value. Subsequently, you need to be vigilant that you need to classify that payment as equity instrument or a financial liability. Depending upon the mode of payment, you apply the principles of Ind AS 32. If the mode of payment is supposed to be cash, it is financial liability. If it is variable shares, it is financial liability. If it is fixed number of shares, it is equity instrument. Remeasurements will be done if it is a financial liability at a fair value, but no remeasurements if it is an equity instrument. That was DC, CCE, and CCS. Then came TC, transaction cost, which is supposed to be expensed off in a business combination setup. If you acquire an asset on a standalone basis, a PPE or intangible assets, TC is generally capitalized as a part of the asset. But in a business combination, this directly attributable cost is going to be expensed in the P&L, not a part of PC. Then we came to the 5th agenda, that is a PHI, a previously held interest, which is also called as a step acquisition, wherein the basic thumb rule is that you need to consider the fair value of the previously held interest. And in this particular cases, we can get 2 combinations: conversion from a passive investment into a control or a significant influence into a control. So you need to remeasure the book value of the investment at a fair value. The gains and losses are taken in the P&L or OCI as the case we saw. And then you also need to remember the concept of that OCI, which needs to be taken care as well. Today, I'm also going to make a complete mind map at a later stage once all the 7 issues are done, which gives you a bird's eye view of all the inputs in terms of the 7 agenda. So that was the issue number 5. And now we're working on the issue number 6, and we're yet to work on the issue number 7. The issue number 6, which I started with you in the yesterday's class, was on SBP, that is a share-based payments. In terms of the share-based payments, we saw that there is going to be a 3-step on the basis of which we will decide how much element is to be taken as a part of the PC. I gave you 2 alternatives. I said either you consider that amount as a part of the step 3, that is step number 3B, when you take the list of net assets, or take it as a part of the purchase consideration. We decided we're going to take it as a part of the purchase consideration. Then you can put a separate entry that is purchase consideration gets a debit and SBP reserve is created. I did not do any questions so far because I need to now tell you something more in terms of share-based payments. So I'm now going to give you some more inputs on SBP before we come to a practical illustration. Now watch this carefully. I am going to start with a little technical note at the very early stage of the class. But the topic, of course, has got its own intensity, so we need to go with the flow. So as we were discussing the concept of SBP, that is the concept of share-based payment. And I, of course, gave you a logic as well that why would the acquirer be interested in, giving these replacement awards? Because he knows that once the ESOPs are issued, his percentage stake could get diluted. So he might be interested in terms of replacing the original awards of the acquiree's employee. So when you look at a share-based payments, I would say broadly there are going to be three kinds of cases which you are going to confront. So far, I've only given you case one, but we are saying that there will be a total of three cases what we are going to confront. It could be a case of what we say a mandatory replacement, or it could be a case of what we call an optional replacement. Or it could be a case where the acquirer refuses to replace, so there is no replacement. So when you're going to look at a question at the first instance, your focus point would be, is it a mandatory replacement? Is it an optional replacement? Or is it a case of no replacement? So how are we going to look at the question and decide that agenda? Nobody. When we go to see the question, I'm going to show you the language, with the help of which you will take a call whether it's a mandatory replacement or optional or no replacement. So the first thing what you need to see that the replacement agenda. So is the acquirer going in for a mandatory replacement, or is it something which is optional replacement? Or it is something which we can say a case of no replacement. He refuses to do any kind of replacement in this case. Now, yesterday what I gave you was a case of a mandatory replacement. The three steps which I gave you was pertaining to mandatory replacement. Let me just remind you the three steps we did in terms of a mandatory replacement. So we decided in terms of the three steps. The first step is just organizing the fair value. The first step is pretty simple and straight. It is just organizing the fair value. So what you need to do, you need to organize the fair value on the date of acquisition, and you need to do this for the original award as well as the replaced award as well. So the question will clearly give you the data that on acquisition date, this is the fair value of the original award and this is the fair value of the replaced award. Thereafter, what do we need to do in terms of step number two? We can say the step number two is considering that what is the pre-business combination portion. And the step number three is considering what is the post-business combination portion. I did not use these words yesterday. I said in step two, you calculate what is a part of the purchase consideration, but I'm just adding a few inputs. The second step will tell you, of course, we are deciding in second step that this is a part of the PC, but it's called a pre-business combination portion. Because what we are trying to do is that the acquirer is trying to create an SBP reserve, which is there in the books of the acquiree. So he is trying to create the portion which is called a pre-business combination period portion. So the second step is going to create a pre-business combination portion, and the third step will create a post-business combination period. So the pre-business combination portion is going to be taken as a part of the purchase consideration. The second step, which is a pre-business combination portion, will be a part of the purchase consideration. And the post-business combination is going to be accounted as per Ind AS 102. It is not to be taken under this particular standard. So what we need to do, basically, we need to account for the fair value in simple words. But once we are accounting for the fair value, so we are accounting for this fair value, mind you. We are accounting for the fair value of the replace award. So the fair value of the replace award is to be split between that this is pre-business combination part of the PC and this is post-business combination to be accounted under 102 share-based payment standard. Now, when you are considering the pre-business combination portion, what we will do, we will take the fair value of the original award, which is there in step number 1, and you need to consider a proportionate figure. You need to consider a proportionate figure, which is vesting period completed. In the numerator, we're going to consider the period which is already completed. And we decided we need to consider total or original vesting period, whichever is greater. And I made a mention yesterday itself, and I said that there is a possibility that as far as the acquirer is concerned, he may change the remainder vesting period. He may either increase the vesting period or he may decrease the vesting period. So the standard set is decided that we will go with the original vesting period or we'll consider the total. Total means what is already passed by plus what is yet to be passed by. So we need to consider original or the revised period, that is the total period, whichever is greater in this case. So this proportion becomes a part of the purchase consideration. And the post-business combination, we will take the fair value of the replaced award from step number 1 minus the figure which is computed in step number 2. So that is how the accounting of the replaced awards will be taken care. So let me remind you again, what we are accounting for is the fair value of the replaced award. The fair value of this replaced award is being split in terms of pre and post business combination portion. So proportion of the original fair value is taken as a part of the PC, and whatever is taken in step 2, the rest is accounted under 102. This is when there is a mandatory replacement. So when there is a mandatory replacement, we are telling the acquirer that you need to create something already in the books through the acquisition entry. So let's take this as a part of the PC. Now let's have a look when it is a case of, you can say, optional replacement. The acquirer is not required to make any replacement, but still he chooses to replace the awards. I think in this particular case, if it is an optional replacement, let's tell him that you can treat this as other than a business combination. So the standard makes it very clear that if you're not mandated, but still you want to make a replacement, then it is an award you can account under 102. So in this particular case, the entire fair value, is a part of post-business combination. It's going to be a part of the post-business combination itself. So when we say that it's going to be a part of the post-business combination, this means what? That you are going to apply only Ind AS 102. So it doesn't make any impact on my acquisition accounting. If it is a completely optional replacement, it is not a part of my acquisition accounting. So in this particular case, you are going to apply Ind AS 102 just like you would have done in a post-business combination setup. Nothing is to be taken as a part of the PC because this is one extreme and this is another extreme, optional and mandatory. Now comes the tricky situation, and that is when the acquirer says, no, I will not replace in this particular case. Now, we need to understand this very interestingly. If the acquirer tells the employees of the acquiree, I will not replace your options, then these options will convert into shares. And these shares will go to outsiders, which you can say is an NCI. Because when there is a mandatory replacement, these options will ultimately, he will give the shares. But if there is no replacement, the employees of the equerry will get the shares of the equerry. Once they get the shares of the equerry, then they will become a part of the NCI. Because acquirer has got a certain stake in the company, and now new shares come into place, and those shares goes to the outsiders, that is NCI. So trust me, in this particular case also, what I need to do is apply the three steps model again. But in this case, there is going to be a slight little change in terms of the three-step, because there is no replacement. There is no replacement. So what I'll do in step number one, I'll organize the fair value on the date of acquisition only for the original award. Unlike in this particular case, you've got original and replace awards, but in this case, there will be no replaced awards, only the original award. So what I'll do in terms of step number two, I'll do the same calculations. I'll take the fair value of the original award and take this on a pro rata basis, vesting period completed. We'll take the vesting period completed upon, let's consider the original vesting period. And this portion which you're calculating is going to be a part of the NCI. It's going to be a part of the NCI. Because this portion which is relating to the pre-business combination is going to be considered as NCI, because now the acquirer will not be issuing its own shares. The equerry employees will be getting the shares of the equerry, so it becomes a part of the NCI. And then we can say whatever is the fair value of the original award in step number one minus the figure in terms of step number two, this portion will be accounted under Ind AS 102. So the post-business combination accounted under 102. Let me consolidate before we do questions on this area. So I'm now giving you a complete map plan in terms of share-based payments. So when you're going to look at a share-based payments, there are three situations to be seen. Either it is a case of a mandatory replacement or optional replacement, or there is no replacement. Now we need to understand each situation very finely. When you say there is a mandatory replacement, let's visualize this also further to get it very clear. So you're looking at, there is a company A and there is a company B. He is acquirer and he is supposed to be equerry. And they've already issued some ESOPs to their employees. So they've already issued some ESOPs to the employee. Now, we need to visualize one thing very clear in this particular case. In the first case, when you say it's a mandatory replacement, when you say in the first case that there is a mandatory replacement, now we need to understand in this particular case, he is required to create an SBP reserve, which is there in the books of B. And since he's issuing his own shares, NCI will not change, because he says that don't give them the shares, I'll give them the shares. So the NCI will not change. So in this case, there is no impact in terms of NCI undergoing a change in the future, because the acquirer company is saying that I will replace these options and give you shares in my company. So the question of NCI cannot change. There is no potential ordinary shares now, because these ESOPs are basically potential ordinary shares, which the acquirer company says, no worry, I'll give you my own ESOPs. So in this particular case, the idea is to create an SBP reserve in the books of A. And for this purpose, what we do, we calculate this using the step number 2, which I gave you, proportionate of the fair value of the original award. You calculate this amount considering the fair value of the original award and you take a proportion. So you take a proportionate amount in this case. Now let's look at the other one, the third case first, where he says no replacement. He says, I will not replace. Now, if he doesn't replace these awards, they will be issued the shares of B. Once he issues the shares of B, the share capital base of B would increase. The share capital base of B would increase, which means more number of shares goes to the outsiders. And in this particular case, the NCI changes. So we need to appreciate this fact that as far as B is concerned, when he's going to give shares to the employees, in that particular case, this will increase the capital base of B, and those shares are going to outsiders. The NCI should change. So what we're going to do, in this case, the NCI is going to be given a credit in the books, and this will again be based on the step 2 calculations. Absolutely similar calculations which are done here, and absolute similar calculations will be done out here. We'll take the proportionate of the fair value of the original award. So in this case, you are crediting SBP reserve, and in this case, you're crediting an NCI, because this is a mandatory and this is a no replacement. And then comes the third agenda, where the acquirer company says it is completely my choice. I want to do it. Now, if it is completely his choice, the standard is giving him a little better liberty. We say, don't worry, you don't need to do anything at this stage, because you've opted to go for a replacement, even if it is not mandated. It's a pure choice you've done. Let's do one thing. Let's not ask you to do any credits at this stage. You can simply follow Ind AS 102 in this particular case. Accounted completely in a post-business combination period. There is no need to do any accounting as of now. Nothing is to be taken in the post-acquisition, pre-business combination period. So the most important inputs to watch out is it mandatory, is it no replacement, or is it optional in nature? Mandatory means creating SBP reserve in the part of acquisition accounting. No replacement means increasing the NCI as a part of the acquisition accounting. And if there is optional replacement, no worries, you are not required to do anything as a part of the acquisition accounting. I hope, friends, I made that clear. My video is stucking again and again. Is there everybody facing that problem, or is it all good now to go? Okay, so I guess now let me take this further as well. So I am now going to take you to some questions on this particular area. So there are some questions in the study material which I have taken. I am just going to take you to the questions in the study mat. So there is an illustration number 27 in the study material, and we are just going to see which case does it fall into. So let's have a look at illustration number 27. I guess all good to go. I hope the video is coming good now. Okay, now look at the language carefully. The language is to be read to identify, is it mandatory, is it optional, or is it a case of no replacement? Now let's read this. Green acquired Pollution Limited, and as a part of the arrangement, he had to replace. The word is he had to replace. I don't think so. I need to tell you what is the interpretation of the word he had to replace. When it says he had to replace, this is indicative that this is supposed to be a mandatory replacement. If it is a mandatory replacement, which means I am now supposed to consider a creation of SBP reserve in the books of accounts, applying my 3-step model. Let's read further. It says there is an existing equity settled award. The original award specifies a vesting period of 5 years. At the acquisition date, the employees have already rendered 2 years of service. So 2 years already completed so far. As required, Green replaced the original awards with its own share-based payment award. That is called the replacement award. and under the replacement award, the vesting period is reduced to 2 years from the acquisition date. 2 years have already passed and another 2 years is required. So we can say now the total vesting period is 4. The original vesting period is 5, but the total vesting period now has become 2 plus 2, 4. The value which is market-based measures on the acquisition date is given. You're given the fair value of the original and the replace awards on the date of acquisition. And then it says, as of the acquisition date, all awards are expected to vest. Determine the accounting for the replacement award. So let me do my 3-step model. So we've seen it's a mandatory replacement. So let's, I think, do the 3 steps. Step number 1. So in step number 1, as I said, you just need to organize the fair value on the date of acquisition for both the original award as well as for the replace award. And that information is very clearly stated in the question. The fair value on the date of acquisition for the original award is 500 and for the replace award is 600. At the end of the day, we need to account for 600, out of which a pre-portion is a part of the PC and the post is going to be 102. Let's go to the step number 2. In step number 2, we need to decide what is a part of the purchase consideration. So we will take the fair value of the original award, that is 500, and take a proportion. The proportion is based on the period completed, and we are already given 2 years are already completed. And in the denominator, the original vesting period 5 or the total vesting period 2 plus 2, 4, whichever is greater. So we take 2 by 5 and that works out at 200. That is a part of the PC. This is the amount with which SBP reserve needs to be created in the books of the acquirer. And then you go to the step number 3, where you need to consider what is the post-business combination portion to be accounted under Ind AS 102. At the end of the day, we need to account for 600, which is the fair value of the replaced award, and you've already created 200 in the acquisition entry. So the remaining 400 is going to be spread over the remainder vesting period of 2 years. This 400 is going to be spread over the remainder vesting period of 2 years and accounted under Ind AS 102. That's the split in terms of 3 steps. Let's have a look. Let's, I think, still read a bit portions of the answer. So we are looking at the pre-business combination period, which is going to be a part of purchase consideration. And if you look at the calculations, you can see accordingly 500 into 2 by 5 is considered as a part of the pre-business combination included in the purchase consideration. Then you've got a post-business combination period, which is going to be accounted under Ind AS 102, spread over the remainder vesting period. So in this particular case, we can say the portion which is left over is 400, and that is to be recorded over the remainder vesting period, which is supposed to be 2 years. So as we said, spread over the remainder vesting period. Because at the end of the day, if you think on a logical level, you are required to account for 600. Because once the acquirer company says, I am going to replace the awards, he is required to create a total SBP reserve of 600. So we tell him something to be created now for the portion which is completed, which comes out at 200. And something will be accounted later, which will be over the remainder vesting period. So the remainder 400 is accounted over the remaining 2 years to go. Right, friends? I hope I am clear with the picture. The mandatory replacement 3 steps is clear. I hope, I trust that. Okay. So let's have another look at another question also, which is given in the study material. And this is illustration number 28. So there's another one, illustration number 28, and let's see the facts of the case. Which category would this fall into? So let's look at illustration 28. It says, P is a real estate company acquires Q, another construction company which has got an existing equity shuttle share-based payment scheme. The awards will vest after 5 years, and at the acquisition date, the employees have already rendered 2 years of service. So 2 years is already completed. None of the awards are vested at the acquisition date, so the time is not yet over. It says clearly P did not replace the existing share-based payments. P did not replace the awards. I think it's very clear. It's a case of no replacement. So when it says it did not replace, that means it is a case of no replacement in this case. He said, I am not going to replace. But at the same time, as an acquirer, he will also have the discretion of making changes in the vesting period as well. So in this particular case, what he did, using his discretion, he reduced the remaining vesting period from 3 years to 2 years, which means the proportion is going to be based on the same parameters as mandatory. That is the reason I said I am writing original at this stage, but I think I want to now make the changes in this particular case. If I just go back and tell you the inputs, I would just like to make a slight little change at this stage. So in this case, it would be appropriate to say vesting period completed, or we can say original, or we can say original vesting period or total vesting period, whichever is greater. The concept would apply the same. So even if there is no replacement, even in that particular case, the acquirer will still get the discretion to change the vesting period. So the concept of the proportion in this case and the concept of the proportion in this case remains the same. That's the change made. Please incorporate the change. So let me just come back on the agenda. So now coming back on this particular issue. So we are very clearly given that this is a case of no replacement, but the vesting period changed from 3 to 2 years. Company P determines the market-based measure on the acquisition date. So I am also given what is the value on the acquisition date. So we are given the inputs. The fair value on the acquisition date is 500 for the original award. Determine the accounting for the market-based measurement. Let's organize the 3-step model back again. So in this particular case, we still apply the 3-step model. Let's go to the step number 1. We just need to organize the fair value on the date of acquisition for the original award, and that is given to me 500. Because it is a case of no replacement, we just need to organize the fair value of the original award. There is no replaced award. Then we go to the step number 2, decide what is a part of NCI. So this case, not part of PC, but decide what is a part of NCI. If I decide not to replace, I am basically increasing the outsider stake, that is NCI. So the calculation would be 500 into the vesting period completed, and the original vesting period is 5 and the total vesting period is 4, whichever is greater. So 200 becomes a part of the NCI. And at the end of the day, we need to do the accounting for 500. So as a part of the post-business combination, out of 500, 200 is NCI. The remaining 300 is accounted as per Ind AS 102, post-business combination. So this is the pre-business combination, a part of the NCI, and this is a post-business combination to be accounted as per Ind AS 102. The steps are the same, but we just need to be careful whether it's a part of the NCI or whether it's a part of the SBP reserve. That needs to be seen. Let's make a little walkthrough on the answer as well. And we can see in this case, the portion allocable to the pre-business combination is 200, which is included and allocated to NCI. And this is the remainder expense, that is 300, is accounted over the remaining vesting period, that is 2 years, as a compensation expense. So I think the position is simple if I just consolidate the points. If it is mandatory, part of PC, pro rata fair value. If it is no replacement, part of NCI, and that is again pro rata fair value. If it is a case of option replacement, relaxed accounting, post business combination, nothing to be taken as a part of the acquisition accounting. So you need to look at the language. And let me also tell you, we've seen two illustrations, mandatory as well as no replacement, but we did not see an illustration where there is optional replacement. Reason, if there is an optional replacement, I have to do nothing in the acquisition accounting. So which means the chances of getting a question in the exams when it is a Ind AS 103 is got to be more on a mandatory or a no replacement, because if it is optional replacement, you're doing nothing as a part of the business combination accounting. So if you got to do nothing, then what's the point of asking? I hope you got the point. So that was the agenda number 6 we have done. Now comes the last area, the 7th issue in terms of the purchase consideration. Now, this is going to be a little more technical, even as compared to the share-based payments, because there is something very interesting which is going to come. If you remember, there was one more discussion pending on the step number 3, and that is called reacquired rights. Oh, yes. So we're going to combine the discussion of a pre-existing relationship and the concept of reacquired rights as well. So get ready for some technical inputs coming in for the next 15 to 20 minutes. Let's go to the next agenda, pre-existing relationship. Now, please watch this chart very carefully. This is again beautiful chart made in the study material, which is pertaining to the concept of pre-existing relationship. So let me just read the inputs to you. Now watch this carefully. Don't worry, we'll make the notes later. Now first have a clear-cut look. The first question what comes to the mind is, what is a pre-existing relationship? I'll give you simple examples on a pre-existing relationship. Let's say there is a company A, acquirer, and let's say there is a company B, acquiree. Let's say company B, before the date of acquisition, couple of years back, filed a legal case against A. So there is a court case going against A by the acquiree. So as on the date of acquisition, they already have a pre-existing relationship. So pre-existing relationships can take various forms, but one of the simplest example which I gave you, that there is a company which is acquirer A and there is a company acquiree, there is B. Before the acquisition date, couple of years ago, he filed a legal suit against him. And that means there is already a relationship between the two. So in this particular case, what do you do with this pre-existing relationship with them? Is there any kind of adjustments which is required? This is the agenda. That before they became acquirer, acquiree, before that particular date, they had some transactions with each other. So how would those transactions impact my acquisition accounting? Let's have a look. The standard says you need to first of all look at the types of pre-existing relationship. So before you consider the accounting of a pre-existing relationship in the question, your focus is to be on the category of relationship. There are 3 categories. Number 1, it is non-contractual in nature. For example, a legal suit. As I gave you the example, let's say the acquiree had filed a legal case against the acquirer, or maybe vice versa. So this is something which is not contractual. It is something which is non-contractual in nature, that is one. Or there could be a contractual example, a supply agreement. So for example, they may have entered into a contract with each other before the acquisition date and had some kind of a relationship. So it could be a plaintiff-defendant relationship. non-contractual, or they may have explicitly entered into the contract. That is called contractual relationship. Or it could be a case of a reacquired right. Now, what is that reacquired right? Let's say before the acquisition date, the acquirer had given some franchisee rights to the acquiree. Before the acquisition date, he had given some franchisee rights to the acquiree. Now the acquirer says, I want to take these rights back. So when he says that I want to take the rights back, it is called reacquired rights. So the pre-existing relationship would be that he has already given some franchisee rights to the acquiree before the business combination a couple of years back. And now the acquirer says, I want the rights back. And that is called reacquired rights. And this is also going to impact the list of the net assets in terms of step number 3B as well. Don't worry, we'll see the accounting. We'll understand that in bits by bits. But what you need to appreciate is there are three kinds of relationship. You need to focus that it is either non-contractual, or it is contractual, or it could result in a reacquired rights. Now, see what is stated out here. If it is non-contractual, we will consider the fair value. We will consider the fair value in this particular case, and that's it. It says we will simply consider the fair value of this particular portion. I think we need to go to a simple example to understand this portion. So there is a small little illustration which is given out here. Let's have a look at illustration 24. Let's see the illustration number 24 in the study material. And we'll see, first of all, what is the type of relationship, and then we are going to see things further. It says Progressive Limited is being sued by Regressive Limited. When it says it is sued by Regressive Limited, it means that there is a legal suit. If there is a legal suit, it means it is non-contractual in nature. So I think at the first instance, we are able to identify the nature of the relationship. The company has put a legal suit. He's sued him in the court of law. It's a plaintiff-defendant relationship, non-contractual. Then he says at 31st March X2, Progressive recognized a 10 million liability related to this litigation. Now, let's see one thing. Progressive was sued by Regressive, and Progressive has already recognized a liability in his books of accounts. Since there was a legal case against Progressive, he has already applied IS 37 and created a provision of 10 million in the books of accounts. On 30th July, now see, this is on 31st March X2, which is before the acquisition date. It says on 30th July, Progressive acquired the entire equity of Regressive for 500 million. So this is the date of acquisition, and the court case is going before the date of acquisition. So you can see one thing very clear, that the acquisition happened on 31st July, and they already had a legal case going on as on 31st March. Which means this is indicating that there is a pre-existing relationship. So when you read the question, you need to be careful on the language, because this first thing is to identify that there is a presence of a pre-existing relationship, and which is indicated from the dates itself, that Progressive was sued by Regressive and he had already created a provision on March X2. But on 30th July, he acquired the entire equity stake. And on that date, the estimated fair value of the expected settlement is 20 million. The company Progressive, which is the acquirer, has already created a provision of 10 million in the books. But on the date of acquisition, it is estimated that the expected value of settlement is 20 million. Now it says, recommend the accounting for such a litigation at the time of business combination in the books, business combination in the books of Progressive. Now we need to understand one thing. Progressive has already created a provision of 10 million. I need to go in for a settlement of a pre-existing relationship. Now, watch this carefully. This is something important. This is progressive limited and this is regressive limited. Now, we need to understand one very simple logic. Progressive tells regressive that I will pay you a consideration. I will pay you a consideration, let's say to the extent of 120 million. Progressive tells regressive. It's just an arbitrary figure, not a part of the question. I'm just assuming arbitrary information. So let's say progressive tells regressive that I will pay you a consideration of 120 million, including the court case which you have filed against me. So he says that considering that I also need to compensate you for the legal court case, I'll pay you 120. But is he paying 120 for acquisition of the business, or is he paying that 120 including the settlement of the legal case? Undoubtedly, he's paying this money including the settlement of the legal case as well. So in this particular case, what I need to do, I should reduce the amount of 20 million, which is the fair value of this liability. So I would calculate what is he paying for the business acquisition. Let's exclude what is paid for the pre-existing relationship. So we can say what is paid as a purchase consideration is supposed to be 100 million. So let's put that once again to you. So what we are saying that if there is a pre-existing relationship, you need to be very careful that if there is a pre-existing relationship, the acquirer tells the acquiree, I'll pay you a totality of 120 million. And this 120 million is inclusive of the court case you filed against me. So I'm paying 120 million including the legal case. So let's leave the portion which is paid for the pre-existing relationship. Only calculate what is to be paid for the business acquisition. So we will reduce the fair value of the amount which is expected to be paid. That's what it says. On the date of acquisition, the estimated fair value of the expected settlement is 20 million. So there will be a need to adjust the purchase consideration. Remember, it's not always going to be a minus. It can be a plus as well. Because in this particular case, the legal case is filed by the acquiree on the acquirer. So in this case, the acquirer is liable to pay a money. Since the acquirer is liable to pay a money, I need to make a reduction out of the purchase consideration. So you reduce the PC, that's one. This is one. You need to make a reduction in the PC. Number two, what you need to do, before you do the acquisition entry, settle the liability as well. Settle the pre-existing relationship. So in this particular case, you can settle the transaction. Now, when you settle the transaction, there is already a provision in the books. He's already created a 10 million obligation. So you can debit the provision to the extent of 10 million, but you are going to make a payment to the extent of 20 million. So the remaining 10 million is going to be debited to the profit and loss at this stage. So there are two things which you need to do. I'm looking at a non-contractual relationship. So in a non-contractual relationship, you will take a debit for the provision already created and make a payment equal to the fair value, difference if any, adjusted in the P&L. Settlement of a pre-existing relationship. Second is you need to make an adjustment to the purchase consideration. Because when acquirer pays a lump sum amount, that is including the settlement of the pre-existing relationship. So get the money which is paid for the business acquisition. Remove that pre-existing amount. Now let's read. In the above scenario, the litigation in substance settled with the business combination and accordingly 20 million is the fair value of the litigation liability will be considered as paid for settling the obligation and will not be included in the business combination. Accordingly, the purchase price, the consideration will be reduced by 20 million. That's what I did. And the difference between 20 and 10 million is recorded in the income statement. So that's what I gave you. So what is the moral of the story? Hear this carefully. We are on the case number 1. Don't worry, we'll pen down the notes as well. When you look at a pre-existing relationship, you need to focus on the type of the relationship. Once you look at the type of the relationship is a non-contractual, generally a legal case with each other. In this particular case, you need to take care of two things. Number one, adjust the PC. I did not say reduce the PC. Because in this case, the acquirer is liable to pay for the legal suit. What if he's already filed a legal suit against the acquiree? In that particular case, he would land up adding it. So I would say what you need to do, you need to adjust the purchase consideration by the amount of fair value. You need to find out that what is the amount of fair value of this existing relationship. Adjust the purchase consideration. In this example, reduce the purchase consideration by 20 million. Next, you need to put an entry. Provision will be given a debit to the extent of book value. The bank will be given a credit to the extent of the fair value, and the balancing figure, if any, is going to be debited or credited to the P&L as the case may be. So these are the two focus entry. This entry will be done before the business combination entry, before the acquisition entry. So before the acquisition entry, settle the liability and also make adjustments to the purchase consideration. That is one. Now let's have a look at the other one, and we're looking at a contractual relationship. Oh my God, now this is interesting. There is given that we need to consider something which is lesser of the two boxes, and we are now going to see what is this two boxes. Let's take an example to understand that better, because this is complicated. So let's take you to another illustration as well. So right now we just saw the illustration number 24. We are now going to see the further illustrations as well. And this is the brilliant illustration which is there. Yes. Now we need to look at illustration number 20. So after 24, we are looking at illustration number 20. So let's have a look at illustration 20. This is on the second case, which is supposed to be contractual relationship. Okay, now let's read illustration number 20, what is stated. ABC acquires PQR for consideration of 1 crore. PC, 4 years ago. When it says 4 years ago, it indicates a pre-existing relationship. This is indicating a pre-existing relationship when it says 4 years ago. So 4 years ago, ABC had granted a 10-year license, allowing PQR to operate in Europe. When he granted a 10-year license, now you need to get this straight. Once the acquirer granted a license to the acquiree, this is a case of rights given to the acquiree. And this could also become a case of reacquired rights as well. So it says he had granted a license to operate in Europe, and the cost of the license was 2,50,000. The contract allows either party to terminate the franchisee at a cost of unexpired initial fee plus 20%. Unexpired initial fees means unamortized value of the license plus a 20% fee. So it says on the date of acquisition, the settlement amount is 180. How did he get the settlement amount? The cost of the license is 2,50,000. So if you calculate the annual amortization, the life is 10 years. So we can say the annual amortization is 25,000 per annum. Now, in this particular case, the license was granted 4 years back. If it was granted 4 years back, the total amortization done so far is 1 lakh. Watch the calculations clear. So we know that 250 is the cost of the license with a life of 10 years. So annual amortization is 25,000. It was granted 4 years back. So the total amortization is 1 lakh. So what is the unamortized value, or what is the book value? 250 minus 1 lakh, the book value is 1 lakh 50. He says if you want to terminate the agreement, you can do it at the unexpired fee. What is the unexpired fee? It is 1 lakh 50 plus a 20%, that makes it 1 lakh 80. So you are telling that this agreement can be cancelled at the unexpired fee, which is the book value of the intangible assets, and plus a 20% compensation. So the settlement amount is given 180. So what are the facts given so far? ABC acquired the company PQR for consideration 1 crore. 4 years ago, the license was granted and anybody can exit out of the agreement by making a compensation of 180 as of today. Let's now see further. And then it adds on a further inputs out here. ABC acquired PQR because it sees a high potential in the European market and it wishes to exploit it. ABC calculates that under the current economic conditions and at the current prices, it could grant a 6-year franchisee at 4 lakh 50. So the acquirer company is evaluating the rights which I gave 4 years back. If this right is given today, then the value is 450, which means this is the fair value of the reacquired rights. Because he makes an assessment the rights which he has given. If they are given under the current economic conditions, then in that particular case, we can say the fair value comes to 4 lakh 50. How is the license accounted as a part of the business combination? Now, friends, you need to see me very carefully. As I said, I know this is technical indeed. I'm just going to first of all tell you the computation part. Don't worry, we will get the logics also very clear. But first, we need to get the conceptual understanding of the computational aspect. Let's see. So we are given some inputs in the standard, and in this particular case, it says the paragraph B52 of Index 103 defines that if the pre-existing relationship is non-contractual, such as a lawsuit, we need to consider a fair value. We've already seen that. That if there is a non-contractual relationship, you need to reduce the PC. If it is a legal suit against the acquirer, and you also need to put a settlement entry as well, that we've seen. Next. It says if the pre-existing relationship is contractual, that's what we're seeing. The lesser of the two. The amount to be adjusted from the PC is the lesser of the two. If it is non-contractual, adjustment is the fair value, 20 million. But if it is contractual, the adjustment is the lower of the two. What are the lower of the two? Let's see. It says the amount of any stated settlement provisions in the contract. So if you want to make a settlement at this stage, we've already seen that you can pay 1 lakh 80 and exit out of the contract. We just saw in the calculations that if either party wants to terminate the agreement and you want to walk out of the contract, you need to pay a compensation of 180 to the other party. So the amount of any stated settlement. And then it says the amount by which the contract is favorable or unfavorable from the perspective of the acquirer. Now let's understand that. You need to compare that what is the amount by which the contract is favorable, unfavorable. If the acquirer would have given a contract today, if he would have given the franchisee rights today, he would have given 4 lakh 50. He would have charged 4 lakh 50. That's what is given. It says ABC calculates under current conditions and at current prices, he would have given the license at 4 lakh 50. He would have given the license at 4 lakh 50, but in this particular case, what is the book value of this particular right? It is 1 lakh 50. So we can say if you compare what would have been charged today is 450 and what was charged and now what is the book value is 150. So when you compare, you can say the difference between the market value today and the book value today on the date of acquisition is 3 lakh. The amount by which the contract is favorable or unfavorable from the perspective of the acquirer when compared with the current market transactions. So in this particular case, we can say from the point of view of the acquirer, it has become an unfavorable situation. He must be cribbing about the fact today that I gave a license of franchisee right, which is in the books at 150. But if I would have given it today, I would have given it at 4 lakh 50. So there is an unfavorable difference of 3 lakh. So we need to consider this 3 lakh or 180, the lower of the two, and that is to be adjusted in the purchase consideration. Don't worry, I'm not done. I'm just giving you the essence. Okay. Now let's see, it says the gain or loss on settlement is the lower of the two. 3 lakhs which I calculated is the amount by which the right is unfavorable to ABC when he compares it with the market terms. That is one. And the second input is that if I were to exit out of the contract. And the second input is that if I were to exit out of the contract, 180 is what I'll have to pay to terminate the right on the date of acquisition. Therefore, the loss on the settlement is 180, the lower of the two. Therefore, out of 1 crores of consideration, 98.2 is accounted as business combination and 180 is accounted as separately a settlement loss. Sir, what are you saying? We did not understand. Can you please explain this again? I know that. I know that. Let me, I think, put this once again. Now watch the second situation very carefully. We are now looking at the contractual rights. Watch this. Let's get the chain very clear that we are looking at acquirer and we are looking at acquiree. So we can say what happened a couple of years back, 4 years ago. Watch this very carefully. Then we'll pen down the notes as well. No worry. Because this is actually not only case 2, but it is case 2 plus 3. It's got reacquired rights as well. We'll come to that. The acquirer 4 years ago had given a franchisee rights to the acquiree. So he had given some franchisee rights to the acquiree. So can I say in this particular case, watch this carefully, in this particular case, he would have recorded an intangible asset in his books. When they entered into a relationship 4 years back, get this clear, when they entered into a relationship 4 years back, the acquiree got some franchisee right and he paid him some money. So when he paid him some money, he created an intangible assets in the books of accounts then. So the intangible asset was recorded in the books of accounts at 2.5 lakhs then. And then he also decided to amortize it over a period of 10 years. So when he decided to amortize this over a period of 10 years, the book value of this intangible assets, as we've already seen, is standing in the books at 150. It is standing at 150. So this is the existing relationship between the two. That the acquirer had given some franchisee rights and therefore the acquiree is reflecting an intangible assets franchisee rights in his books of accounts, which has got a book value of 1,50,000. Now, let's see further. Now what is happening as of today, the acquirer says that I want this right back. He says that I'm getting a control over your business, so I'm going to incorporate the acquisition entry. I want to get this right back. Because this is, this is an asset in the books of the acquiree. And as a part of the acquisition accounting, I am in any case going to record all the assets and liability. So when the acquirer does an acquisition entry, when he does an acquisition entry and he puts the entry that is assets debit, liabilities credit, and the purchase consideration gets a credit and the NCI gets a credit. Now we're focusing on this entry. Now, when the acquirer puts an acquisition entry in this case, what is he supposed to do at this particular stage? As a part of this asset, he needs to record this intangible asset, which is being called as a reacquired rights. Which is being called as a reacquired rights. I hope you get the picture clear. So, as a part of this acquisition entry, the acquirer is supposed to record that intangible asset back in the books of accounts. Now it is a case of reacquired rights because he had given these rights and he is reacquiring these rights. And he is going to record this intangible asset at a fair value, which is to the extent of 4,50,000. Because he's already made an assessment. He's already made an assessment that if I were to give these rights today based on the remainder period, which is 6 years, these rights would have been given at 450. So he should be incorporating the reacquired rights at a fair value. This is what is the step number 3B. This is the step number 3B, that when he creates the list of net assets acquired as a part of the list of net asset, he needs to consider the reacquired rights also at a fair value. So this is one thing which he is required to do. This is one thing which he is required to do. I hope I'm clear on the picture. So the first thing what we need to consider in this particular case is that when he is acquiring these rights, so he is saying that there is an intangible assets in the books of the acquiree, and now I'm going to incorporate this in the acquisition entry, and I am going to record this at a fair value, which is 4.5. That's one. Second, now I'm looking at the second agenda. In any case, there is a pre-existing relationship as well. If you notice, there is already a pre-existing relationship. Now, we need to see that there is a settlement of a pre-existing relationship. So, which means let's tell them that you please settle the pre-existing relationship. Now, how would the acquirer settle this pre-existing relationship? He says, I will walk out of this contract. Let me walk out of this contract. So what is the amount he's going to pay if he exits out of the contract? Let's forget about the other part. So what is the amount he will pay if he wants to exit? Because this right is being given to the acquiree, and if he wants to take the right away, he needs to pay that money. He needs to compensate money to the acquiree company in terms of walking out of the contract. And the agreement allows that whatever is the book value, which is 150, you add a 20% to the book value and you pay 1.8 lakhs as the amount to settle the transaction. So he is going to tell the acquiree company, boss, you take this 1.8 lakh and give this right back to me. I want to walk out of the contract. So which means he will put an entry profit and loss account debit and bank gets a credit, and he's going to settle the transaction at 1.8. So get the position clear. At the first instance, he needs to incorporate the reacquired rights as a part of his acquisition entry at a fair value. At the second instance, he needs to settle the transaction because he is given that right. So he needs to compensate, he needs to pay a penalty to, walk out of the contract. So we calculate this 1.8 lakhs is paid in order to settle this obligation. But what is the purchase consideration he paid? He paid a purchase consideration of 100 crores. Or was it, I think, how much? Yes, it was 1 crore. If the purchase consideration is paid 1 crore, that 1 crore is including that 1.8 crores, which is a compensation to cancel, 1.8 lakh. So the third input, what you need to do is you need to reduce the purchase consideration. You need to reduce the purchase consideration by 1.8 lakh. So there are three things to be done. There are three things to be done. Number one, you need to first of all settle the obligation, pay the penalty, and settle the contract. So the settlement of the pre-existing relationship involves a payment of the compensation. That is one. Second, the purchase consideration paid is 1 crore 100 lakhs. So out of that 100 lakhs, what is paid to settle the pre-existing relationship? Eliminate. So you effectively paid 98.2 lakhs for the purpose of acquisition. And thirdly, since it is a case of reacquired rights, you also need to incorporate this in the acquisition entry. Sir, we got the flair, but if you remember, in terms of calculating this amount, the standard was saying something of lower of the two. You've just taken the amount of settlement. You are not talking about the lower of the two. I'll now talk of the lower of the two as well. The standard says that the amount of gain or loss is the lower of the two. One is the amount which you pay, and the other one is that you compare. So, if you ask me, technically speaking, the comparison between the book value today and the fair value today is like comparing something like an opportunity cost. It is comparing in terms of what is the real loss. So if you say that I gave a right which is in the books at 150, and if I give a right today, it is worth 450, the sufferance, the loss which I've actually suffered is 3 lakh. But I can pay 180 and work out of the contract. So in this particular case, what is the amount I can pay and work out is 180. So the clause number 1 is looking at, like, for understanding perspective, it is looking at something like opportunity cost, where you're saying that let me compare the book value of this right versus the market value of the right. Let me see what is the real loss I've suffered. I have suffered 3 lakh rupees by giving this right. But at the end of the day, I can walk out of the contract by paying a lesser money. So I need to put an entry based on the settlement amount. I don't have a question, otherwise I would have taken you to the length of explaining if the figure, which is a comparative, was less than 180, how would the accounting take place? We will not get into that. So for the understanding point of view, you need to keep 3 factors into account. Let me consolidate the picture. Then I'll make some notes as well. So let me just come back on the picture. So we have basically covered the second and the third case put together. Now let me just correlate the inputs to you. Then we'll make some notes on this. If it is a case of a non-contractual contract, 2 things to be done. If it is a case of a contractual right, 2 or 3 may be done. So the 2 things here is adjust the PC and put the settlement entry. If it is contractual with reacquired rights, 3 things to be done. 3 things to be done. The first is you need to settle the transaction. You need to settle the pre-existing relationship. As we did in the given case, paid 1,80,000 as a penalty to terminate. Second, we need to make a reduction in the purchase consideration, because that should be eliminated, because the consideration paid should be reduced by the amount which you paid to settle the relationship. And number 3, as a part of the acquisition entry, you need to incorporate the reacquired rights as a part of the list of net assets. So these are the 3 things which will be required to be done. So you can see the measurement is based on the stated settlement penalty to exit, and compare the favorable, unfavorable position, take the lower of the 2, lesser of the 2. And the fair value is taken as a part of the entry. It is capitalized and recorded in the acquisition entry. Let's make it more systematic. Let's pen down some notes now. So in a pre-existing relationship, there are broadly, I would say, 2 cases effectively. Because if it is a contractual relationship, it would simultaneously also lead to a reacquired rights as well. Because if there is a contractual relationship giving rise to an intangible assets in the acquiree, it will also lead to reacquired rights as well. So let's, I think, pen this down. So this is my 7th agenda. So let's, I think, have a look at the 7th agenda in this case. So let's now make some notes. Then I think we'll look at a complete comprehensive package of all the 7 issues put together. Wow. So now we are looking at the 7th issue, which is pre-existing relationship. So we are looking at a pre-existing relationship in this case. So when I'm looking at a pre-existing relationship, at the first instance, what you need to do, you need to first of all evaluate the type of relationship. So we're going to first of all look at the type of relationship. So when I'm looking at the type of relationship, I would broadly put it into two categories. One is, I would say, is non-contractual. One is, we can say, is non-contractual. We can give an example. It is a legal suit. It is a legal suit. As the company ICAI filed a legal suit in the illustration 24 against the acquirer. Or the other one could be that it is contractual in nature. It is contractual in nature. So what are we supposed to do now? In the first case, the moment you reach a conclusion that it is non-contractual in nature, what do you need to do? Two things. What do you need to do? Two things. Number one, you need to settle the transaction. You need to settle the pre-existing relationship. So you need to put an entry for the settlement of the pre-existing relationship. So when you say that you're going to settle the pre-existing relationship, the entry in this case is provision is going to be given a debit if there is book value, if any. If he's already created a provision, and this entry is based on the presumption that there is a legal suit by the acquiree. My entry is based on the presumption that there is a legal suit by the acquiree. So provision already in the books of the acquirer. So provision will be given a debit at a book value, and the payments will be, bank will be given a credit, which is at the fair value. And the difference in this entry, so any balancing figure in this entry is going to be taken in the profit and loss. This is a gain or loss on the settlement of a pre-existing relationship. Second, the second input, what you need to do, you need to adjust the purchase consideration. In the given example, what we did, we made a reduction from PC. I'm considering the example which we did, illustration 24, as a base. So in this case, we did the entry, if you remember, provision debit 10 million, bank credit 20 million, difference in the P&L debit, and the purchase consideration was reduced from the PC. So we reduced from the PC the fair value of this particular amount. This is the two things to be done. Now comes the input. If it is contractual in relationship, then there are three things to be done. Number one, we need to settle. We need to settle the pre-existing relationship. So we need to settle the entry for the pre-existing relationship. And in this particular case, there will be no provisions in the books. Because in this particular case, it's not a legal suit for which you would have created a provision. So the entry is going to be profit and loss account debit, and the bank will be given a credit. And this is going to be equal to the lower of the two. This entry which you're going to pass is going to be at the lower of the two. Generally, I'm saying generally, this entry will be for the penalty to exit, generally. So in this particular case, when you are going to see the lower of the two, the first one is penalty. The first one is penalty to terminate. Like in our example, 1,80,000 was the amount which was paid to terminate the agreement. He needs to compensate the acquiree to terminate the agreement. So 1,80,000 was the compensation to terminate, and we need to compare that what is the market value. What is the market value versus the book value of the intangible? So market value was 4,50,000 and the book value was 1,50,000. So we need to compare the market value and the book value to get what is the unfavorable amount. Though effectively you will see most of the times you'll end up paying a penalty only. I am not getting to the situation where this amount turns out to be lesser. Let's assume for convenience of accounting, the penalty paid is going to be the amount which you will pay to exit. So you put this entry with the settlement figure, that is one. Second, the second thing what I need to do, I need to again adjust the purchase consideration. So here again, I will make a reduction from the PC. I will reduce the reduction from the PC the way I did out here. And this is again, the amount of reduction is the same figure. So 1,80,000 is what is paid, and then this gets reduced from the PC. And the third thing is reacquired rights. The reacquired rights recorded at a fair value is going to be recorded at fair value as a part of step 3B. So this is going to be recorded as a part of the list of the net assets in part number 3B, which was recorded at 450. So we paid 180 compensation, we reduced the PC by 180, and we recorded the reacquired rights at 4,50,000, which is the fair value based on the remaining tenure. So this is the pre-existing relationship settlements, how they are going to be accounted for. All the 7 agendas in terms of the consideration is done. I now need to do a little mind mapping, which is very necessary before we go further on this. Let's, I think, consolidate a bit. So I am now going to first consolidate this. My step number 4 is done, but we need to do step number 5 and 6 as well before we go to the larger question with you. But before this, I am now going to make a comprehensive chart combining the concept of the step number 4. Let's be very clear on the step number 4, purchase consideration. Let's consider a mind map. So we just need a one view in terms of how the agenda of all the 7 issues will be taken care. What are you going to do on the acquisition stage? What are you going to do in a post-business combination stage? So let's get the mind map very clear. So let's create a wonderful chart. And I am considering the list of 7 issues. And I want to understand what is going to be done as a part of the acquisition accounting. Let's say as a part of the acquisition accounting, what do you do on date of acquisition? And what is to be done in a post-business combination as well. So we need to be clear now on all these 7 issues, what is done on acquisition date and what is done on the post-business combination accounting as well. Let's begin. So I'm looking at the list of 7 issues at this stage. Number 1, I'm looking at a deferred consideration. Deferred consideration, the focus is part of the PC at a fair value. So this is going to be a part of purchase consideration at a fair value. And what is that fair value? It is the present value of the future cash outflow. It is the present value of the future cash outflow in this case. Anything to be done in terms of post-business combination, unwinding of discount. So you are going to pass an entry, finance charge gets a debit and the deferred consideration gets a credit. So this is agenda number 1. This is the agenda number 1, the issue number 1. You need to be very clear in terms of the movements. It is a part of the PC and then unwinding at a subsequent dates. Let's see the agenda number 2. We're looking at a contingent consideration shareholders capacity. This is also a part of the purchase consideration and it is taken at a fair value. And this fair value will of course be given in the question. So what is to be done subsequently? You need to classify it as financial liability or equity instruments. You need to classify this as a financial liability or as an equity instrument. If it is a financial liability, it is remeasured at fair value. It is going to be remeasured at a fair value and the changes entered in the P&L. If it is equity instruments, then there is no remeasurements in this case. Nothing is done. So the subsequent accounting is the fair value remeasurements if it is a financial liability, and you know the considerations. So let's go to the next agenda as well. Let me just draw a fresh line. And then we go to the next agenda, that is 3. There is a contingent consideration in the employee capacity. It is not a part of PC. It is not a part of the purchase consideration. This is not to be taken as a part of the purchase consideration, but it is to be accounted. It is supposed to be accounted as per Ind AS 102 Journal E. So you're going to basically account it as a share-based payments, because something which is being given in the employee capacity is going to be accounted under Ind AS 102 or maybe Ind AS 19, as the case may be, employee benefits standard. And then let's look at the next agenda as well. The next agenda was in terms of the TC, that is a transaction cost. Now, when you look at the TC, it's again not a part of purchase consideration, but it is immediately expensed. It is immediately expensed in the profit and loss in this case. And there is no post-business combination accounting applicable to this area. So this is the 4 issue. Let's continue further. Let's continue the chart further for the next 3 agendas as well. So once you're looking at the step number 4, your mind needs to be very clear that what is to be done for each and every permutation combination. So let's again continue with the issue list. So we've got the 7 issues. We're looking at what is done on acquisition accounting, that is on the date of acquisition, and what is done on the post-business combination accounting as well. Now, coming back to the next agenda, we saw the concept of TC, transaction cost, next, number 5. Now, next, in terms of number 5, we've got a PHI, that is a step acquisition, previously held interest. So there is a PHI, so we can say we need to revalue. We need to revalue the PHI at a fair value. And in this particular case, the fair value gain or the fair value loss enters into the P&L or the OCI, as the case may be. So it's going to be entered into the P&L or the OCI, as the case may be. And I think if you want to see the further inputs to control or significant influence to control, and you also need to take care of the accumulated OCI. So there are 2 things. One is the fair value gain or loss is taken in the P&L, and the second is the accumulated OCI. The accumulated OCI is to be taken to RE or P&L, as the case may be. Depends upon the case. So the accumulated OCI will be taken to the P&L or retained earnings, as the case may be. The main focus which I want to put across at this stage is that your mind should be clear in terms of what considerations will play in the mind. So 2 things will come at the mind at that stage. That you need to first of all update the fair value, get the gain or loss taken in the P&L OCI, and also keep a track of the accumulated OCI. So 2 considerations will play. Nothing is done in the post-business combination in this case. That is the issue number 5. Let's have a look in terms of the next issue, that is issue number 6, which is a share-based payments. In terms of the share-based payments, now we need to watch out the 3 cases which we did. So in this particular case, you need to watch out, is it mandatory? We need to watch out, or is it supposed to be optional? Or is it supposed to be something which is no replacement? So if it is supposed to be mandatory, then it is a part of PC. And if it is supposed to be optional, then it is post business combination accounting. And if it is no replacement, then it is a part of the NCI. So you already know the inputs well, that what is to be taken in this particular case. So we are going to consider a part of PC mandatory, post business combination optional, and part of the NCI when there is no replacement. So the only inputs to be done, even if it is mandatory, something will be done in a post combination. Optional is completely in a post combination. And if it is NCI, then also post. So in all these three cases, there will be something accounted in the post business combination. Here the remaining portion, here the entire portion, and here the remaining portion. So you can say in terms of the mandatory, in terms of the optional, and in terms of no replacement. So we can say a portion is accounted in the post business combination, entire is accounted in the post business combination, and again a portion is accounted. Why I'm saying portion? Based on step 3, and this is full portion accounted under post business combination. The next agenda which we got, that is the seventh issue. The seventh issue which we had is in terms of pre-existing relationship. The next agenda is in terms of pre-existing relationship. And when you're looking at the pre-existing relationship, what comes in the mind is non-contractual or contractual. So in this particular case, the focus would be, is it non-contractual or is it supposed to be contractual in nature? So when it is non-contractual in nature, two agendas to be taken care. And the two agendas is, you need to settle the pre-existing relationship and you need to make a adjustment to the purchase consideration. When it is contractual in nature, three agendas to be taken care. One is that you need to settle the pre-existing relationship. Second is we need to adjust the purchase consideration. And the third is we need to record the reacquired rights, if any. So we need to record the reacquired rights, if any, as well. And in terms of the post-business combination, nothing further is to be done. So this gives me a complete bird's eye view in terms of things. You would have noticed now that I've captured all the 7 issues in terms of what is done on the acquisition date and what is done in the post-business combination period. Your mind should be absolutely clear in terms of the permutation combination. DC part of PC at fair value, then unwinding. CCS part of PC at a fair value, and then classification will decide the subsequent treatment. CCE not a part of PC, simply accounted later as a part of employee benefit standard or share-based payment standard. When you're looking at a TC, it's immediately expensed. When you're looking in terms of the PHI, there are 2 factors to be considered. You need to consider the fair value updation, and we need to be considering that accumulated OCI balance as well. When you're looking at the concept of share-based payments, depends upon the category. Is it mandatory? Is it optional? Or is it no replacement? And when it is a pre-existing relationship, depends upon contractual and non-contractual. So if it is non-contractual, 2 things: adjustment of PC and settlement, and if it is contractual, adjustment of PC settlement, and also recording a reacquired rights as well. I hope, friends, this mind map gives you a complete chain of thought and clarity in terms of how the step number 4 will be tackled. What do you say? Are we clear with the concept of step number 4, which is one of the most grave step? In fact, if you notice, we have spent almost like 1.5 class understanding the step number 4 in detail. But we are still on the 7 steps on the acquisition accounting. My step number 5, goodwill. My step number 6, rather, I would say step number 5 is NCI, and the step number 6 is goodwill. And we are, of course, working towards the 7th step, which is a part of the acquisition entry. Okay, that's wonderful indeed. So far, so good. I think now it's time we give you a little break as well. I'm sure you'll need that, because after the break, I would now do my discussions on the NCI and the goodwill, and then I'm interested to do a full-fledged question with you. We're going to do a little smaller question because we are going to first see a walkthrough on all these 7 steps. So there are some interesting questions as well. We'll see, depending upon the time frame, whether we can do a bigger question or we can do a smaller question with you. Because after the acquisition accounting is done, we've got some very good agenda in the next class to cover the concept of reverse acquisition and a common control as well. So let's first relax your minds at this stage. I am going to give you a 10-12 minutes break to relax your minds, and then we'll start back on step 5. Right, friends. So we'll see you after the break. Okay, thank you. So I hope you had a relaxed mind, and I think the technicalities are over. We're done with the step number 4. Now I am going to take you to the next step number 5 and step number 6. The step number 5 is the calculation of the NCI, and step 6 is the goodwill. So let's go to the next step of discussion, and we're looking at the step number 5 now. The focus in terms of step number 5 is the calculation of the NCI. That's what we call the non-controlling interest. So we're looking at NCI, which is the non-controlling interest. So we're already familiar with this term, that what is an NCI? It is the portion which is held by other than the acquirer company, basically held by the outsider. Now, when you consider the calculation of NCI, the standard has given us two alternative calculations. The company can choose its own accounting policy, and they can calculate the NCI based on two alternatives. Let's see what are the two alternatives which are given. Now, as far as the exam is concerned, which alternative is to be applied will be very clearly stated in the question. So we'll be very clearly given in the exam that this is the particular alternative to be applied. So the first alternative which is given in the standard is called that you take the NCI at a fair value. The second alternative which is given in the standard is that we consider the NCI at what we in short call it as PASNA. It is called proportionate share in net assets. It is called proportionate. The word P is proportionate share in net assets. Of course, the calculation of the NCI will be different under both the circumstances. Your value of the NCI will come different, so it would be based on the instructions that you consider NCI at what value. Now, if you consider the NCI at a fair value, what I need to consider in this case is I need to consider the number of shares which is held by NCI. Calculate the number of shares which is held by the NCI and multiply this with the fair value per share of acquiring company. So multiply this with the fair value per share of the acquiring company in this particular case. So we need to just consider the number of shares which is held by the outsider and multiply this with the fair value per share of the acquiring company. Now, alternatively, if you consider the second alternative, that is PASNA, what I need to do, I already have the net asset list with me. You've already organized the step number 3B, getting the net assets, just take the percentage stake. So we will consider what is the net assets as per step number 3B. So you've already organized the net assets in step number 3B. Just multiply with the percentage stake of NCI. So we need to see that what is the share of the NCI in the net assets of the company. So the calculations is going to be pretty simple and pretty straightforward indeed. So the instructions will be given. We will either consider the number of shares into the fair value per share, or we'll consider the net assets into the percentage, and you will get the answer. But of course, these two alternatives will have implications in terms of the calculation of the goodwill as well. Because if you're going to consider NCI based on a fair value, or if you're going to consider NCI based on a PASNA, you are going to get two different answers for goodwill. That we'll see in the next step. I don't think so. I really need to tell you how the calculations of NCI will be done. We can take a question along with goodwill in that case. So this is step number 5. Now let's go to the next step, that is step number 6. And step number 6 is also quite mathematical indeed, that you need to calculate the goodwill, or we don't call it as a capital reserve, but we call it as a bargain purchase gain. Because when you calculate the difference in the acquisition entry, you're going to get a goodwill or a capital reserve. But we don't call it as a capital reserve. We technically give it a name called a bargain purchase gain, but it's as good as a capital reserve. Now, in this particular case, when you calculate a goodwill or bargain purchase gain, there is a little, way in which the calculation is done. What you used to do in terms of accounting standard 14 in the intermediate stage, here it is going to be slightly different. And the reason why it is different, you'll see that mathematical inputs also. So what we're going to do in this case, when you calculate the goodwill, we will first of all consider the purchase consideration, which you've already calculated in step number 4. So in order to calculate the goodwill, you're going to consider the purchase consideration as a base, which is already calculated in step 4. To this, we will add the NCI. And this also you've already calculated in step number 5. And you can see on a mathematical front what is happening. In step number 4, let's say the consideration is paid for 80% shares. So this represents 80%. And when you add the NCI, which represents 20%, automatically the sum total of this will give you 100%. So you add the purchase consideration, what is paid for 80%, for example, add the NCI, which is for 20, add it up, you get 100%. And then the comparison is you need to compare this with the net assets, which you've already computed in terms of step number 3B. And this is also the 100% net assets itself. So you can see the logic that when you add the PC and NCI, mix it 100, compare it with the net assets. So you are comparing 100% versus 100%, and the difference is going to be a goodwill or a capital reserve. So in this particular case, we're going to get the goodwill or the capital reserve as the case may be. So let's say if this total is A, and let's say if this total is B. So possibility number 1 is that A is greater than B. Then the difference is called goodwill. The possibility number 2 is that A is less than B. In that particular case, the difference is called a capital reserve. So it's going to be a simple mathematical kind of an exercise where you just need to compare the sum total of the PC NCI versus the net assets, get the difference, goodwill or a bargain purchase gain, which is nothing but a capital reserve. Now there is something which is crucial to the calculations of NCI. And I think I want to do that crucial calculations at this stage. Before I take you to a comprehensive question, because my steps per se is done, I've given you the inputs in terms of all the 6 steps. 7th one is just organizing the inputs, what you've taken in first 6 steps and putting an acquisition entry. But I think before we do a larger question, let's do one thing. Let's do a little more extension discussion on this goodwill concept. So let me now take a little example to illustrate the concept of goodwill. Because this is now going to be a little crucial discussion which will help you in terms of not only Ind AS 103 but also in the consolidation standards, where you will see the concept of what is called full and a partial goodwill. So I'll explain that with a simple example. Let's do one thing. Let's consider a small chart, and in which I'm going to consider some permutations and combination. I'm going to consider case 1 where there is no NCI. I'm going to consider case 2 and 3 where there is an NCI. So I'm going to consider 3 cases for the calculation purposes. So I'm going to consider the case number 1 where I would consider no NCI. Then I would consider the case number 2 where there is NCI, NCI is present, and I want to take the case number 3 as well, where there is an NCI present as well. In the case number 2, I will take the NCI at fair value, and in the case number 3, I'll take the NCI at PASNA. So these are the 3 combinations I'm working on. No NCI, there is an NCI at a fair value, there is an NCI at a PASNA, and I want to see some comparative inputs in this case. So let's organize the data for the calculation of the goodwill. So we are going to consider the purchase consideration, and to this we are going to add the NCI, if any, And once we get the sum total, we compare this with the net assets and we are going to get the goodwill. So we'll take the sum total of this, compare this with the net assets, and we will be able to get the amount of goodwill or the bargain purchase gain as the case may be. Now watch this carefully. What I'm going to do is maths. What I'm basically going to do is simple maths. Let's consider that the company acquired at a consideration, let's say to the extent of 250 crores. All the figures I'm taking in crores. So let's assume that the company acquirer got a 100% stake. You got a 100% stake at 250 crores. So there is no NCI. So the sum total of this is 250 crores. And let's say the net assets is 200 crores. So when you compare the difference, we get a goodwill of 50 crores. As simple and as straight. Now let's see the second case. I'm taking the same figures as a base, but I'm now considering that let's say you acquired an 80% stake. So let's assume that we got an 80% stake with a 20% NCI. Let's say we got an 80% stake with a 20% NCI. Now, naturally, if you pay 250 crores for 100% stake, naturally for 80% stake, you're going to pay only proportionate money. So 250 is what you paid for 100%. So what do you pay for 80% is 200 crores. Now the question is, what is the NCI? I guess the purchase consideration represents the business valuation. So in this particular case, let's consider this is the business valuation. So 20% of this, 20% of this belongs to the NCI. So the value of the NCI is 50 crore. Basically, if you notice, I have taken 80% of this as a consideration paid and I've taken 20% of this as NCI because I am taking NCI at a fair value. The sum total of this is 250. You compare this with the total net assets and you get a goodwill of 50. So in this particular case, we get the goodwill which is 50 crores. Wow. I'm sure an immediate question will flash in your mind as well. You would be now thinking that when you acquired a 100% stake, you got a goodwill 50. Even if you acquired an 80% stake, you're still getting a goodwill of 50. Is that a chance or is this something which is bound to happen? Let's put that question to you. What do you think that with no NCI, you're getting a goodwill of 50, even with a 20% NCI, you're still getting a goodwill to the extent of 50? Is that a pure chance or is this something which is bound to happen? Look at the maths involved. What I've done, I took 80% of this here, I took 20% of this here, but the sum total of this still remains 250. So in this particular case, I would say it is got to be. This will mathematically happen. Well, yes, it may not happen for certain reasons, which I don't want to discuss at this stage. But we can say that at the end of the day, when you add that 80 plus 20, it converts into 100%. So which means that this goodwill, which is calculated, is technically called a full goodwill. This is called a full goodwill. So which means that if you're going to consider the NCI at a fair value, get the chain clear. If you're going to consider the NCI at a fair value, you will get the goodwill which would have been had you acquired a 100% stake. So that is why it is called a full goodwill. So when the company chooses the accounting policy of taking the NCI at a fair value, the goodwill which you're going to get is a full goodwill. Alternatively, let's see the next case as well. So in this case, we acquired 80% stake, let's say at 200 crores. But now the NCI is being taken at a pasna. So when you say it is taken at a pasna, then I am supposed to consider 20% of this. This is the total net assets and 20% of this is 40. So I'm not going to consider the percentage of the PC, but the net assets, 20% of this belongs to the NCI. So this works out at 240 and the net assets is 200. We get a goodwill to the extent of 40. And you can see something interesting. If you see 50 is the goodwill, and if you consider 80% of this, it comes exactly equal to 40. Your stake is 80%, your goodwill is coming 80% of 50, that is 40. And it is for the simple reason what you're technically doing. Alternatively, if you look at this, you paid a total of 200 crores against which you got 80% of the net assets. You can directly compare your own stake. You can directly compare your own stake. You can say, I paid 200 crores for 80% and I got 80% net assets. So my goodwill is 40. And therefore, this goodwill is called a partial goodwill. This is called a partial goodwill. Now, let me make one thing very clear. If your NCI is at a fair value, you get a full goodwill, which means this goodwill is pertaining to both parent and NCI. Get this clear. When you're calculating the NCI at a fair value, you get a full goodwill, which is a goodwill pertaining to both parent and NCI. When you consider the NCI at PASNA, you get a partial goodwill. This is a goodwill pertaining to the parent company only. So it's a matter of accounting policy choice. When the company chooses NCI at a fair value, it chooses to show the goodwill which belongs to both the parent and NCI. If it takes an NCI at a PASNA, it chooses to reflect the goodwill, which is only his own goodwill. I do not reflect the NCI share of goodwill in the balance sheet. And this will have implications at the time of impairment testing under Ind AS 36. Mathematically, this is the chain, but this will have implications when you conduct impairment testing under Ind AS 36. When it is a full goodwill, any impairment loss happening which is adjusted against goodwill in Ind AS 36 will be split between the parent and NCI both. The impairment of goodwill will be borne by the parent NCI both. But if the NCI is taken at a PASNA, the goodwill impairment will be borne only by the parent company. I think I must make a note on this point. So, moral of the story, what is the implications is what we need to keep in mind very clear. So we need to keep one thing very clear in the mind. When you are looking in terms of NCI at a fair value, or when you are considering the NCI at PASNA, so there are certain implications which we need to be clear on, because this will have implications on the impairment testing, which you will see in bigger questions on 103 and even on consolidation 110. So we can say, number one, in this particular case, when you calculate a goodwill, if NCI is at a fair value, we get a full goodwill. If it is at PASNA, we get a partial goodwill. What do you mean by a full goodwill? This means it belongs to. This is the goodwill which belongs to both the holding company and the NCI. And if you're looking at a partial goodwill, then this is a goodwill which only belongs to, which is attributable to only the holding company, not to the NCI. So when the company chooses the NCI at a fair value, it decides that I want to show the goodwill of both the parent and NCI. If it is PASNA, I want to show the goodwill which is only for the holding company. That's one. Second, the second input in this particular case is if you apply Ind AS 36. If you apply Ind AS 36 and carry out an impairment testing, you already know that as per impairment testing, goodwill takes the first hit. When there is an impairment loss of a CGU, at times when you do the impairment testing for a cash generating unit, you will first take a hit on the goodwill. So we can say the decrease in goodwill due to impairment will be borne by, it'll be borne by both the holding and NCI. So it's going to be borne by both the holding and the NCI in this case. Since the goodwill relating to both the companies, both the stakeholders is appearing in the balance sheet, the goodwill impairment loss will be borne by the parent and the NCI. But in this particular case, if due to impairment testing, there is a decrease in goodwill, then it is borne by the holding company only. It is borne by the holding company only in this particular case because the goodwill of NCI is not even appearing in the balance sheet. So this is one thing you need to be very clear as far as the implications of NCI on the goodwill and the impairment is concerned. So keep the chain clear. Goodwill is full or partial depending upon the method of NCI. If you take a full goodwill, impairment is borne. The goodwill impairment is borne by both. If it is partial goodwill, impairment is borne by the parent company only. Right. So this is the input in terms of the step number 6. I'm now done with all the 6 steps with you, and the 7th step is basically a total of all the 6 steps. I think now we should do a comprehensive question with you with all the steps in mind. Let's take you to a question in the study material. I'm now going to take you to a question which is there in the study material on this area. Okay, I'm not taking that NCI at the moment. Let's have a look at a question number 1, which is there in your test your knowledge. Now, as we read the question, please consider the walkthrough of all the 6 steps I've given you. If you ask me, this is a very simple question, but I think to kick off, I am doing a simple question with you. So let's have a look at this. It says company A and company B are in a power business, and company A holds a 25% equity shares of company B. The moment it says I've got 25% stake, it tells me that A has got a significant influence. Now see the way I read and analyze the question. So A has got a 25% stake. There is a significant influence, which means this is a case of a PHI. It's a previously held investment because you've got a 25% stake in the company already. And then it says on 1st November, company A obtains a control of company B. And that means this is the date of acquisition. When it acquires a further 65% shares, thereby resulting in a total holding of 90%. So there is a 10% NCI as well. 25% plus another 65% makes it 90. Then he gives you about the purchase consideration. It says company A transfers a cash and it also issues shares on 1st November and the market price is 10 rupees per share. So the consideration is in the form of cash and the consideration is also in the form of shares. We'll take the fair value of the shares and the cash as a part of the PC. Then there is a contingent consideration as well. And there is an impact of a TC as well. It says company A agrees to pay an additional consideration, which is supposed to be, it says there's some misprint in the figure. We'll see that if the cumulative profit exceeds, there is a condition if the cumulative profit exceeds 70 lakh over the next 2 years. At the acquisition date, it is not considered probable that extra consideration will be paid, but you're given the fair value of the contingent consideration. Now, in this particular case, I am nowhere given that this consideration is going to be paid in cash or shares. I assume it is paid in cash. I assume it's a financial liability, but that would decide the fate later, as on the date of acquisition, we'll take the fair value. The TC, that is acquisition related cost, is given, and this is definitely going to be expensed in the P&L. Then he also tells you about the NCI. The fair value of the NCI is determined at 750 on the acquisition date based on the market price, and company A elects to measure the NCI at a fair value on this transaction. So the policy of the company to take the NCI at a fair value clearly given. Then he tells you about the previously held PHI as well. So he's giving you the inputs about the PHI. This was about the NCI. It says company A owned 25% shares for several years, and on the date of acquisition, 1st November, the investment is consolidated at 6 lakh rupee. This is the book value as per the equity method. It says clearly using the equity method, and the fair value is given 20 lakh. There is going to be an updation of the PHI required. The fair value of the net assets on the date of acquisition is 60 lakh, determined in accordance with Ind AS 103. We're required to do the acquisition accounting as is stated in the question. Now, the question is very simple, but I want to give you the flow of how these 7 steps is going to be applied in this particular case. So we're going to go step by step and we're going to see how we are going to work out this solution. So let's see the question, the answer to the TYU1 of the study material. Let's have a look. So when you're concentrating on the 7-step model, get your focus very clear on each and every step. Just focus on the step concerned. So at the first instance, we go to the step number 1, where we need to basically determine who is the accounting acquirer. So I need to basically evaluate that who is the accounting acquirer. Now your mind should go back to the step number 1 and you need to see, did we create a new company? No. Is the consideration primarily in shares or cash is to be seen. Now, in this particular case, we can see the consideration is paid 59 lakhs in cash with 1 lakh shares of 10 rupees. That is 10 lakh in share. I would say the consideration is primarily in cash because 59 lakhs is in cash and only 10 lakh is in shares. So in this particular case, we can make a conclusion that we can tell the examiner no new company is created. No new company is created. So this is one observation which you need to tell the examiner, that no new company is created, and we can say the purchase consideration is primarily in cash. A major component is supposed to be paid in cash, and based on this inputs you can decide that in this case, if a new company is not created and the consideration is primarily in cash, we can say the legal acquirer and the accounting acquirer is same. The legal and the accounting acquirer in this case is absolutely same, which means the company A, which is the legal acquirer, also becomes the accounting acquirer as well. Tell the examiner your thought processes, that you know the considerations which governs the identification of the accounting acquirer. Let's go further. Then we go to the step number 2, and in terms of the step number 2, we need to organize the date of acquisition. The date of acquisition is when the control is acquired. So we need to see what is the date when the control is acquired by the company A. And that consideration is also very clearly stated. It says clearly on 1st November, A obtains a control of company B. So your date of acquisition undoubtedly is supposed to be 1st of November. That's also clearly stated in the exam, in the question. Then let's go to the step number 3. Now, when you go to the step number 3, you need to be careful. I said you need to consider step number 3A and step number 3B. Immediately, what starts coming to the mind? Am I given any tax rate in the question? No. So Ind AS 12 cannot trigger. So there is no tax rate given. The tax rate is not given. Since the tax rate is not given, we can easily do the conclusion that Ind AS 12 not applicable. There is no need to organize anything as far as the deferred tax asset and liability is concerned. See the focus. And then you go to the step number 3B in order to organize the list of the net assets. And we need the list of the net assets at a fair value. And immediately, when you start looking at the list of the net asset, what should come into the mind is all those exceptions: contingent liability, indemnification assets, reacquired rights, everything what should come to the mind. But if you look at the question, I don't see that there is any references to any of the exceptions. He is directly giving you the net assets at 60 lakh. There are no internally generated intangible assets as well. Nothing is stated. So in this particular case, we are directly given the list of the net assets is to the tune of 60 lakhs. No exceptions, nothing is given. Absolutely a plain vanilla question to begin. Then let's go to the step number 4. Once we're done with the step number 3, we go to the step number 4. When you go to the step number 4, the idea is to calculate a purchase consideration. I would say in a bigger question, you can easily make a list of the 7 issues as well. Let's do that. So we can say basically as a part of the PC, you need to consider cash. You need to consider the fair value of shares issued. This is something which will always be there as a part of the PC. And then you can consider the list of the 7 issues. See if there is any DC. See if there is any CC, which is shareholders capacity. See if there is any CC, which is employee capacity. Get the list. So to keep a track in terms of what is there or what is not there. Next, number 4, we'll look at a TC, a transaction cost. Then we've got PHI, previously held interest. Then we've got a share-based payments. And then we've also got a pre-existing relationship as well. I think it's a great idea in terms of documenting the list of the 7 issues as you're calculating the purchase consideration. At least it'll give you a track of what is there in the question. You don't miss out on any information. Now, if I go back to the question, we can see that as far as the consideration is concerned, the cash is 59 lakhs. So we can say the cash consideration is to the extent of 59 lakhs. The fair value of the shares is to the extent of 10 lakh because there are 1 lakh shares at the rate of 10 rupees market price. Is there any deferred consideration in the question? No. Are we given a contingent consideration? Yes. And we need to identify that this contingent consideration is paid in the capacity of the shareholder. So we're given on the contingent consideration that this is going to be paid if the cumulative profit exceeds 70 lakh over the next 2 years. The condition attached is not a service condition. The condition attached is a profit achievement criteria. So it is definitely in the capacity of the shareholder, and the fair value of this consideration is given to me. It is 3 lakh. So this is 3 lakhs. There is no contingent consideration employee capacity. TC is there, but it's not a part of the purchase consideration. Then you've got a PHI. We're already given the fair value of the previously held investments as well. So we're given that the fair value of the portion which was accounted under equity method is 20 lakhs. So we know that PHI is supposed to be at 20 lakhs. There is no share-based payments. And there is no pre-existing relationship which is defined in the question. And that gives me the amount of the purchase consideration as well. So you can see if you go step by step systematically, there is hardly any problem in this case. So this works out at 92 lakhs as the purchase consideration. My step number 4 is done. Now let's organize the step number 5 and the step number 6. So let's go to the step number 5. So in terms of the step number 5, we need the NCI. Instructions are very clearly stated in the question that NCI is being taken at a fair value. Very clearly stated. NCI is at a fair value. So we can have a look at what is the value of the NCI. NCI is determined at 7,50,000 on the date of acquisition. So we're clearly given the NCI on the date of acquisition is supposed to be 7.5 lakhs. Then I go to the step number 6, in which I am required to calculate the goodwill or the bargain purchase gain. Let's call it as BPG. And this is just organizing the inputs. Just add the purchase consideration. The purchase consideration was 92 lakhs. And to this we add the NCI, which is 7.5 lakhs. The total works out at 99.5 lakhs. And then you compare this with the net assets, which is computed, I guess, 60 lakhs. And we are going to get the difference as goodwill. That works out at 39.5 lakhs is the amount of goodwill. Simple and straight. And now we are ready to organize the acquisition entry as well in terms of step number 7. So let's see the step number 7 as well, which is the acquisition entry. So we're looking at the acquisition entry in this particular case. So as far as the acquisition entry is concerned, this is going to be done in the books of A. So this is going to be done in the books of A, and it's going to be done on the date of acquisition, that is 1st November. Give the examiner the clarity that you are very clear on the inputs. You are working on each step with a complete clarity of thoughts. So what is the entry which we are supposed to do? The net assets will be given a debit. The purchase consideration will be given a credit. The NCI will be given a credit. And the goodwill, which is going to be the balancing figure, is going to be given a debit. And we already have the data with us. The net assets in this case is 60 lakhs. The purchase consideration is 92.5 lakhs. The NCI is supposed to be, this is 92 lakhs. The purchase consideration is 92 lakhs. The NCI is supposed to be 7.5 lakhs. And we already get a goodwill of 39.5 lakhs. So that is the acquisition entry done. Superb. So that was a pretty simple and straight question. You must be thinking, can this kind of a question come in the exams? It has. A similar kind of question has already come in the exams as well. Sometimes you can be lucky and you can get this kind of a question also in the exam. This was only to give you a fair idea of a walkthrough in terms of how the accounting of 7-step model is done. Now let's do one thing. Let's go on to a comprehensive question wherein I will just give you some basic inputs at this stage. Because the question is big, it's going to take a lot of time. I'm basically want to do the calculation of the purchase consideration. In short, I want to do the complete analysis of the question with you. So there is a question in the study material. And this is one of the questions which is also similar kind of question has come in the exam. This is illustration number 40. Wow. So this is illustration number 40, which is in the study material. A similar kind of question has come in the exams as well. We're now going to read the question and get the grip. But I think before we go further, let's get your comfort zone scores on a scale of 10. Because now we've done all the 7 steps and we've done a basic question on all the 7 steps as well. So before we go to the technical question with you, let's get your comfort zone scores on a scale of 10. What is your comfort zone? Superb. 10 by 10. That's wonderful indeed. Okay, so now I think let's read this question. We'll make a walkthrough and read because we've got limited time. So I am going to make some good analysis out of this. The balance sheet of Professional and Dynamic on 31st March X2 is given. So we're given the balance sheet in this particular case. I don't think so. I am doing any analysis looking at the balance sheet, but we are given some huge information. And I think now this is time to do some good analysis at this stage. Now we are given in the additional information that Professional acquired 70% shares of Dynamic on 1st April X2 by issuing its own shares in the ratio of 1 share for every 2 shares of Dynamic. Now we can see that the consideration is primarily in terms of share. When the consideration is primarily in terms of share, your step number 1 should trigger that in this particular case, we need to check if it doesn't turn out to be a reverse acquisition. So I want to do some analysis at this stage itself. I want to first of all go to the step number 1 at this stage and identify that who is the accounting acquirer. I want to first of all look at some accounting and see who is the accounting acquirer at this stage. Now for this purpose, let me organize the number of shares in the balance sheet. I guess if I look at the balance sheet of the company, we know that equity shares, the equity shares number is to be seen carefully. Professional has got a shares which is 10 rupees each. So this company has got a share which is 10 rupees each. And as far as Dynamic is concerned, the shares are 100 rupees each. Dynamic has got a shares 100 rupees each. So which means this company has got 50 lakh shares and that has got a total of 4 lakh shares. So let's organize the data. So in this particular case, if you look at professional and if you look at Dynamic, we've got the number of shares. The number of shares in professional is 50 lakhs and the number of shares for Dynamic is supposed to be 4 lakh. Now let's see what is given out here. Professional acquired 70% shares of Dynamic and it will issue 1 shares for every 2 shares of Dynamic. So the company Professional said that out of 4 lakh shares, I will acquire 70% of your shares and I will give you 1 share for every 2 shares held. Which means I'll land up issuing how many shares? So we acquired 70% and we are going to issue 1.4 lakh shares. So Professional will be issuing to the acquiring company shareholders 1.4 lakh share. So I want to see what is the post-business combination percentage. If I look at the post-business combination, company Professional has got 50 lakh shares. Once it issues 1.4 lakh shares to the shareholders of acquiring, his capital base increases. His capital base becomes a total of 51.4 lakh. So we want to see, is the percentage getting diluted to such an extent that the control is gone or the control is still there? So 50 upon 51.4, his stake gets diluted to 97.3%. The control is diluted, but the control is still there. The percentage got diluted, but the control is still there, which proves the fact that this is, in this case, the legal and the accounting acquirer in this particular case is the same. So we can say Professional Limited is supposed to be the legal and the accounting acquirer in this case. That's a great analysis. Let's go ahead. Okay, then I am given further information. It says the fair value exercise resulted in the following. We are given the fair value of the property, plant, equipment. Now, the moment I see the fair value of the property, plant, equipment, it reminds me the step number 3B. Then he says Professional Limited also agreed to pay an additional payment as a consideration, which is, now see this paragraph very carefully. This is interesting. It says Professional also agreed to pay an additional payment as a consideration, which is the hire of 35 lakhs and 25% of the excess profits in the first year after acquisition over the profits in the preceding 12 months. Now he says that I will give you a consideration which is the greater of the two. Which is the greater of the two. He is willing to pay a consideration which is 35 lakhs or it is 25% of the excess profits, whichever is greater. Does this mean that he will land up paying for sure? He's land up going to pay for sure a 35 lakhs. So let's imagine in this particular case, let's do the analysis. Let's consider the possibility 1. You're looking at 35 lakhs and let's say 25% of the excess profit is 20 lakh. So you'll end up paying 35. You need to pay the greater of the two, so you'll end up paying 35. Second possibility, you say 35 lakhs or 25% of the profit. Let's say it turns out to be 45. You'll end up paying 45. Does this mean that you will definitely pay that 35 lakh rupees? Because if you're going to pay the higher of 35 and 25% profits, you will pay minimum 35. So you will pay at least 35 in both the cases. So what you're going to pay 35 for sure is not contingent. It is supposed to be a deferred consideration. Because when you tell these stakeholders that I will give you 35 lakhs or 25%, it is only the excess over 35 lakhs which is contingent. So we can say in this particular case, 35 lakh rupees, what is being paid is a deferred consideration. And it is only the 25% of the excess which is going to be a contingent consideration. And it is necessary to calculate what is DC and what is CC. And then it says further that this additional amount is due after 2 years. That proves it that it's a future payment. Dynamic has earned 10 lakh profits in the preceding years and is expecting to earn another 20 lakhs. So in this particular case, we'll consider the contingent consideration as well. Let's see further. So it says in this particular case now, in addition to the above, professional also agreed to pay one of the founder shareholders a payment of 20 lakh provided he stays with the company for 2 years after acquisition. This is a payment which is given to the shareholder, but he is also supposed to be agreed to be a founder shareholder provided he stays with the company for 2 years. Is the payment dependent upon the conditions, which is a service condition for the next 2 years? Yes. And that means this is a contingent consideration in the employee capacity, because the conditions attached is in terms of serving for the next 2 years. It is CCE, not to be taken as a part of the purchase consideration. Then it says Dynamic had also got certain equity settled share-based payment award, which was replaced. It indicates that it is supposed to be a mandatory replacement. Because when it says it was replaced, this is indicative that this is supposed to be a mandatory replacement in this case. And it says, as per the original terms, the vesting period is 4 years. And as on the acquisition date, the employees have already served 2 years. And as per the replace award, the vesting period reduced to 1 year, which means the original vesting period is 4. And you can say the total vesting period is 2 plus 1, 3, whichever is greater. The fair value of the award on the acquisition date for the original and the replace awards is also given. So this is pertaining to the share-based payments which is there. Then it says Dynamic has also got a lawsuit which is pending with a customer who made a claim of 50 lakhs and the management estimated the fair value of this liability. This is supposed to be a contingent liability whose fair value can be reliably measured. If this is a contingent liability whose fair value can be reliably measured, you are going to take this as a part of the step number 3B. Then he says the applicable tax rate is given. The tax rate is given, which means I should now be thinking in terms of deferred tax as well. So you are required to make an opening consolidated balance sheet of professional on 1st April, and we are also given a discount rate because DC is going to be considered at a discounted rate itself. My step number 1 is done. Step number 2 is also done because the date of acquisition in this case is 1st April. I think I want to concentrate now on the step number 4. Before we go to step 3, I want to see the purchase consideration. That is the core element of this. So let's do one thing. Let's calculate the purchase consideration at this stage. I'm going to make a little walkthrough as far as the purchase consideration is concerned. Let's see this carefully. So we are now going to consider the calculation of the purchase consideration. So I am going to make a walkthrough of the consideration, but let's do it in our own formatting. We'll match up the answer. So I am wanting to look at the details of the step number 4 because I think the main step is the step 4, the calculation of the purchase consideration. As suggested earlier, first make a list of the 7 issues and then proceed. See if the consideration is paid in cash or if there is any fair value of the shares to be issued. And then you can consider the list of 7 issues, which I'm just going to write down. See if there is a deferred consideration. See there is a contingent consideration shareholders capacity. See there is a contingent consideration employee capacity. See there is a TC transaction cost. See there is any PHI. see if there is any share-based payments, and see if there is any pre-existing relationship as well. So that will make the life simple, and we will be able to organize the data carefully. So let's, I think, get back to the inputs. Was there any consideration paid in cash? No. The consideration was primarily paid in terms of shares, and we've already seen that he acquired 70% shares, gave 1 for every 2 shares, and there was a fair value. Let's get the data. So if I consider what was the number fair value of the share, the fair value of Professional Limited is 40 rupees per share. So let's calculate the number of shares. So in this particular case, there were 4 lakh shares of the acquiree. We acquired 70% shares, issued 1 share for every 2 shares at the rate of 40. So the calculation is pretty simple. We acquired 70% shares, issued 1 for 2 shares at the rate of 40. So 4 into 70% by 2 into 40, that works out at 56 lakhs. All the figures are in lakhs. Now, as far as the deferred consideration is concerned, we've already seen that the deferred consideration was 35. Because when we said we'll give you the higher of the two, 35 or 25% profits, whichever is greater, 35 is confirmed. So we consider 35 lakhs, and this payment is going to be made, I guess, after 2 years. So this payment is due after 2 years, and the discount rate is 10%. So take the discounted value. Consider the discounting at the rate of 10% for a period of 2 years. So 35 will be discounted at 10%. That comes to 28.93 approximately. And then comes the amount which is supposed to be the contingent consideration, which is in the capacity of the shareholder. So here it says that this additional amount, it says, what are we going to pay? Let's see what are we going to pay in this particular case. We will pay 35 lakhs and 25% of the excess profit. Now, the company has earned 10 lakh rupees profit in the preceding year and expects to earn another 20. So they've earned 10 and they will earn another 20. That means 30. So in this particular case, if they're going to earn 30, we are saying that we'll give you 25% of the excess profit. So in this case, if you take 25% of the excess, it comes below 35 lakhs. If it comes below 35 lakhs, that means I will not land up paying this money. If I will not land up paying this money, then in this particular case, we're not considering anything in this particular case. Let's go further. So there is nothing which is paid in the employee. TC is not a part of the PC. There was no previously held interest as well, so nothing to be taken. There is no pre-existing relationship as well. So the only input now to be taken is the share-based payments. So when it comes to the share-based payments in this particular case, let's see what is the fair value of the original award. The fair value of the original award is 5 lakh, and we need to take a proportionate of this. The vesting period completed is 2, the original vesting period is 4, and the total is 3. So we're going to take 5 lakhs into the proportion. So we take 5 lakhs, vesting period completed is 2, and divided by original 4 or total 3, whichever is greater. So 2.5 becomes a part of the purchase consideration. Let's add this up. 56 plus 28.93 plus 2.5, that works out at 87.43. So 87.43 is the purchase consideration. This matches with the figure out here. Step 1, step 2, step 4 is done. Now let's do the step number 3 as well. I wanted to do step 4 because I thought I might run a little short of time. Now, let's go back and let's now have a look at the step number 3 as well. Oh my God, technical. I generally see, when I get too technical indeed, my board also tells me this is getting too technical. Just give me a second. Hopefully the file should get saved as well. Let's have a look now on the inputs. Just wait for a minute. So my step 1 is done. Step number 2, acquisition date is very clearly there. Let's now look at step number 3A. That is the calculation of the deferred tax, and the step number 3B as well. Oh, hopefully we've saved. Okay, so let's go back to the agenda and let's work on the step number 3A and step number 3B as well. So we're going to look at the step number 3A and step number 3B in this particular case. So I'll do my own calculations, I guess. Yeah, we have the inputs in terms of step 3A. Let's, I think, consider the calculations on step number 3A and B. So I'll do my own calculation. We'll just match up with the figures as well. So let's, I think, have a look in terms of how I would now organize my step number 3A and the step number 3B. Because once you've organized the basic step number 3 and 4, I think step number 5 and 6 is not a big issue. Getting goodwill NCI and getting the entry is very simple. Now, in terms of the step number 3A, we are looking at the application of Ind AS 12. So when you're looking at the application of Ind AS 12, your focus should be on all those assets and liability which are taken at a fair value. If you remember reading the question, there was a PPE which was at a fair value and there was a contingent liability which was at a fair value. So we need to organize the items and see what is the carrying amount compared to the tax base, so we can get the temporary difference and decide is it taxable or deductible in nature. So in terms of the property, plant, equipment, the carrying amount, of course, will be equal to the fair value. So I think if I just go back and see what is the amount of PPE. The fair value of the PPE is 350 lakhs. That becomes the carrying value. But for the tax base, it would remain at 500 lakhs. So we can say if I calculate the PPE, the carrying value is 350. The book value of the PPE is the tax base, because the taxation authorities will give you a deduction equal to the original cost. So my carrying amount is 350 and the tax base is supposed to be 500. This leads to a difference of 150. The tax base is greater. So when the tax base of the asset is greater, it is supposed to be a deductible temporary difference. So this is a deductible temporary difference which will lead to a DTA. So we'll take care of the DTA later. So let's now look at the contingent liability as well. I guess if I look at the contingent liability, so we are given that the contingent liability at a fair value of 5 lakh rupees. So contingent liability is got 5 lakhs, but tax authorities will not allow any deduction. So in this particular case, you can say the tax base is going to be the book value, which is 5 lakh, minus the deduction which you will get at a later stage. So tax base will become nil. The carrying amount is greater, so this difference of 5 is also deductible temporary difference in nature. The PPE and the contingent liability both are resulting in a deductible temporary differences cumulatively to the extent of 155. This is a deductible temporary difference. A deductible temporary differences will result in a DTA. And I guess the tax rate is already given in the question. I guess the tax rate was to the extent of, I think, 30%. So we can take a DTA, which is going to be captured as a part of the list number 3B. So 155 into 30%, that works out at 46.5 is the DTA. This is the step number 3A, where you can just pick up those items of assets and liability where the fair values becomes the carrying amount and compare it to the tax base, get the DTA DDL. Now let's also organize the step number 3B as well. And in terms of the step number 3B, we need to get the list of the net assets. And I think before we forget about the list of net assets, remember The DTA in step number 3A is undoubtedly a part of your list. So we would consider, I think let's begin with a DTA that is 46.5. Rest, I think we can just go back to the balance sheet and pick up the items from the balance sheet itself. So I guess if you look at the items in the balance sheet, except for PPE, this is going to be taken at 350. And I guess rest of the item, investments continues at the same. So all these figures will be taken as it is. And even all the liabilities will be taken. There is a DTL as well, which we will consider. So let me just, I think, copy the figures only. And let's see the input. So I guess if you look at the property, plant, equipment, if you look at the property, plant, equipment in this case, you're going to consider the fair value, which is 350. Investments in the balance sheet will be taken at a book value. So that's 100. Then you are given the trade receivable in the balance sheet, book value, the cash and the cash equivalents in the balance sheet, book value. I'm just picking the figures here. Then there is some other assets, again taken at a book value. So all these items are taken at a fair value. If the fair value is not given, you'll end up taking the book value itself. Then you make a reduction of the liabilities. Least I forget, the contingent liability is 5 lakh. And in the balance sheet liability side, we've got long-term provisions. We take the book value. So long-term provisions, we take the book value, that is 70. Long-term borrowings, we take the book value, and that is 200. There is a DTL in the balance sheet that is to the extent of 35. There is a short-term borrowings in the balance sheet, and that is 150. There is a trades payable in the balance sheet, and that is to the extent of 300. So this is going to give us the list of the net assets as well. So items for which fair values are given, take them, otherwise the book value becomes the fair value. So 46.5 plus 350, 100, 300, 100 and 230. And you reduce the liabilities in this particular case. 46.5. So this works out, I guess, to the extent of, I am getting a difference. Let me just check it once again. So this is 46.5, 450, 400 and 230, 75, 235, 450. Is coming to 366.5. Did I miss out anything? I guess PPE is done, investments, inventories. Oh, we missed on the inventories. So inventories is to the extent of 150. Yes, I think we get the total that is coming to 516.5. This is the net assets list with me. Okay, so I think now you are clear in terms of step number 1, 2, 3, 4 of this question. Now getting the NCI and getting the goodwill is not a big deal, and then putting the entry is not a big deal. Okay, so I think the crucial steps are taken care, and we can just quickly maybe have a look in terms of the goodwill as well out here itself. So we've calculated the net assets as 516. The NCI is taken at a PASNA, and that is my step number 5. And when you add to the PC the NCI, you compare the sum total versus the purchase. Sorry, you add the PC and the NCI, compare it with the net assets, we are getting a capital reserve. So this is the step number 6 as well. I think now it's pretty easy. So in this particular case, I guess we have done step 1, step 2, step 3, step 4, step 5, and step 6. Now you just need to organize the entry and put it. Now there is something more which is there at the back of the mind. The question is asking you to make an opening balance sheet as well, which I will discuss. I am not still done with the question, but I'm going to give you this analysis in the next class with you. Before I take this forward, My 6 steps are done, but what is the role of the consolidated balance sheet? That part I will be explaining further. But other than that, my entire concept of acquisition accounting is done. So what we're left now is with the discussions in terms of reverse acquisition and common control transaction. The next class would be the last class on Ind AS 103, because after that we'll be starting with Ind AS 110. So I think we're going good. Our time frame is fine. So in the next class, I would be concentrating in terms of reverse acquisition as well as in common control transactions. Not very heavy topics, but yes, reverse acquisition can be a little more challenging. So we'll discuss that. That's not an issue. But before we'll discuss the reverse acquisition common control, I will also give you insights on the concept of the bridge. What is the connection between 103 and the connection between 110 and the connection in terms of Ind AS 27? That will take a little time. So I'm going to spend some few minutes, a little time in the next class, giving you the connect of 27, 103 and 110 as well. But what you need to do, friends, now at this particular stage, we have covered all these steps with you. So you need to do one thing. You need to make a cumulative revisions of the concept. So in the next class, when we do the reverse acquisition and the common control, we stand fairly clear on the concepts. Right, friends, so let's get on to you. Any questions coming on your side? Any question, friends, on your side? Otherwise, I think we are done for the day and we'll see you in the next class. Any questions on your mind? Wonderful indeed. It's all clear. That's great. Right, friends, so then it's time to bid you goodbye. Enjoy your Sunday and let's meet on the next class. Thank you very much. Bye-bye and take care. Thank you. Angie, thank you. Same to you. Bye-bye.